So you use my tax savings formula from the last video, and it shows you getting a $10,000 tax refund if you buy this house. And I know there's two general thoughts that come to mind. First, is John telling me the truth? Is that formula even correct? And then the other is that while that big refund sounds great, you don't want to wait until the end of the year to get all that money, especially if you plan on using that to help pay your monthly mortgage payment. In this video, I'm going to address those two concerns. I'm going to show you exactly how to validate those tax savings yourself, and then how to get that tax refund money back each month in your paychecks. First, a quick recap of the tax savings formula. The basic rule is that you can write off all mortgage interest that exceeds $4,600 if you're single and $19,200 if you're married filing jointly. You multiply the excess interest by the sum of your top tier federal and state marginal tax rate, which gives you an approximate amount of your tax refund. If you didn't watch the full video deep dive into tax savings, I've just linked it right here. Definitely check it out. Validating income tax savings is a very important step, especially if you plan on using that refund to adjust your housing budget. You know, most loan officers are not trained to understand income taxes, and as a result, they overstate the real benefit by thousands of dollars. And that's why you should adopt the philosophy of trust but verify when shopping financial products. So how can you verify it? You know, if you have a CPA, it's very easy. Just call them. They will take the information that I'm going to share with you next. They're going to plug it into their software and they're going to give you the exact amount. But if you don't have a CPA, don't worry. You can do exactly what they do. You're just going to plug it into tax software like TurboTax or H&R Block. And if you filed your last year's tax return using a web-based service, it's going to be really easy. You're going to use that exact same file for this exercise. If not, we can build one very quickly following these steps. So don't worry, it's pretty simple. Here's what you're going to need to complete this exercise: your W-2 from the most recent year, the anticipated loan amount, the interest rate, and the estimated property taxes. Now, to illustrate how all this works, I'm going to use a real borrower with real income taken directly from a W-2. It's a single buyer making $148,000 a year in Washington, D.C. The desired loan amount I'm going to use is $550,000 at a rate of 6.75, just to match the example from my prior video. Total annual interest will be $36,000 after rounding down a little bit, and the property taxes will be $5,000. Now, before we use the tax software to get the exact number, let's use my calculation just to see how my formula compares with reality. We have annual interest of $36,000. We have a top tier federal tax rate of 24%. and 8.5% for DC. That's a total of 32.5% top tier marginal tax rate. And the math is really simple. $36,000 of interest minus the remainder of the standard deduction after the SALT limits, which is $4,600. And then we're going to multiply that by the top tier tax rate, 32.5%, and get a refund of $10,205. Now let's do the real validation. The first step is to prepare your tax return. Most online services, they only charge you when you go to file the actual return. So just move forward answering all their questions and inputting your personal information. It shouldn't cost you a thing. Now, to keep it simple, I would only enter your personal income shown on your W-2, and I wouldn't bother linking any bank statements or any of your trading accounts. Once completed, you'll see exactly how much you owe or will receive as a refund. When I did that for this client, the federal refund was $1,395 and $1,541 from Washington, D.C. for a total refund of just shy of $3,000. Now, using my mortgage interest tax credit formula, their tax refund should be about $13,000 total. So let's see how it works. Next, we need to trick the system to act like you owned a home and had a mortgage. Simply go back to the deductions section. You need to tell the system that you owned a home last year. They may ask you to link institutions, but obviously we can't do that. So go ahead and click through to select typing in your own information. From here, we complete the fields for the Form 1098, which is the document the mortgage servicer sends you each year for this very specific purpose. You're going to enter the annual interest, the loan balance, the loan origination date, just put the first day of last year for that one to be easy, and then finally add the property taxes. Once that's done, you can toggle back to the end to see exactly how much those tax amounts changed. In our example, we see the federal tax refund increased to $9,111, and DC's refund moved up to $3,849 for a total refund of, you guessed it, $12,960. Now, our formula said $13,000, so it's safe to say this works pretty well. And in my last video, I joked about how getting married would actually cost this guy more money because the standard deduction actually increases by $15,000 for married couples. And at a 32.5% tax bracket, that's about a $5,000 loss per year. But because the overall tax brackets changed, the refund still increased by another $5,000. It went from $9,000 to $14,000. Now also know the taxes are paid based on your life as of the last day of the year. So when buying a home, it's wise to think about these future changes so that you can build a more sustainable long-term budget. Now, as a general rule, I don't usually like Uncle Sam holding on to my money during the year, so there's a trick to getting some of that money back sooner. If you go to your HR portal, there is typically a section for your paycheck tax withholdings. You can adjust your W-4 exemptions to have your employer take out a little less tax with each paycheck, thus giving you a little bit more money each month to spend, especially for your house. Using our client's example, the federal refund increased by $7,700, and he gets paid every other week or 26 times a year. So if we divide that into the refund amount, that's $296 per paycheck. Now let's say he just wanted to increase his paychecks by $225 just to have a little bit of a buffer. He would simply increase his exemptions on his W-4 by 1 and then wait a paycheck cycle to see how much larger the direct deposit was. If it wasn't enough, you just do it again until you reach your bogey. So now you know how to validate the tax savings and how to get some of that money back within each of your paychecks every month. You can begin to tighten up your housing budget. And while there's endless information online, I will say having a real conversation with an expert, it can bring great clarity and confidence for your desire to buy a house. And if you need this type of analysis or expertise on your side, feel free to reach directly out to me. My information's down in the description. My team is always here and happy to help. Thanks so much, and I look forward to seeing you in our next video.